Hey everyone, and welcome back to the Investment Diary. Today we're diving into a stock that's been making a lot of noise lately. PANW, Palo Alto Networks. This cybersecurity giant has seen its stock price drop significantly, leaving a lot of investors wondering what's going on and is this a buying opportunity? Before we start, if you're getting value from this video, please subscribe to the channel. We just passed 50 subscribers, so a huge thank you to everyone who's followed the Investment Diary. Now, let's dive into it. Why PANW stock dropped? The recent dip in PANW stock can be traced back to a few key events. First, the big shocker. News broke that Palo Alto Networks is in the late stages of acquiring CyberArk, another major player in cybersecurity, for a staggering $25 billion in a cash and stock deal. This deal has spooked investors for a few reasons. The valuation is a major concern. Palo Alto is reportedly acquiring CyberArk for around 19 times its sales, while PANW itself trades at a much lower multiple of around 7 times, which has raised fears that they could be overpaying. Second, any large acquisition brings risks, dilution for existing shareholders, and the always tricky process of integrating two massive companies. This led to a downgrade from a key analyst at KeyBank, which only added fuel to the fire. Second, the company's recent Q3 FY25 earnings report was met with a mixed reaction. While they did beat expectations on revenue and earnings, they only raised the lower end of their guidance. This left some investors wanting more. There were also slight misses in key metrics like RPO, remaining performance obligations, and a slowdown in the growth of their next-generation security ARR. Finally, it's important to remember the broader market. Rising treasury yields have put pressure on high-growth tech stocks, and with its rich valuation, PANW was particularly vulnerable to a sell-off. Is it an overreaction? So, is the market overreacting to these short-term fears? There's a strong argument to be made that it is. The company's fundamentals are still incredibly strong. Revenue is up 15% year over year, and their next-generation security ARR is still growing at a robust 31 to 34%. About 90% of the company's revenue is from subscriptions, giving it a stable, predictable stream of cash flow. They have a massive long-term RPO of around $13.5 billion, which gives great visibility into their future earnings. The need for cybersecurity isn't going away. In fact, with the rise of AI, cyber threats are only getting more complex, which should drive demand even higher. This is likely why a majority of analysts, 42 out of 58, still rate PANW as a buy. However, we can't ignore the real risks. The integration of CyberArk is a huge undertaking, and it could be a bumpy road. The slowing year-over-year growth trajectory is something to watch closely, and the company's valuation is still quite high, with a P/E ratio of around 99x. Why long-term investors still like PANW? Despite the recent turbulence, there are several reasons why long-term investors are sticking with Palo Alto Networks. 1. Recurring revenue. Their business model is a fortress. The high percentage of revenue from subscriptions means strong customer lock-in and predictable cash flows. 2. Platform expansion. The CyberArk acquisition, while risky, is a strategic move to expand their platform. It takes them from being a leader in firewalls and cloud security into the critical and high-growth area of identity security. This move helps them become a one-stop shop for a wide range of cyber solutions. 3. Tailwinds from AI. As AI becomes more prevalent, it creates new attack surfaces for hackers. Palo Alto's focus on AI-driven security and its strategic acquisitions position it well to capitalize on this growing threat landscape. 4. Financial strength. The company's financials are solid, with strong free cash flow and operating margins. They are a well-run business with a massive client list, including 85 of the Fortune 100 companies. What to watch for next? The next big event is the Q4 FY25 earnings report on August 18, 2025. This will be a crucial moment for the stock. We'll be watching for a few key things: revenue growth. Analysts expect around 14 to 15% year over year. EPS estimate. The consensus is for an EPS of roughly 87 to 89 cents per share. Key metrics. Pay close attention to the guidance on next-generation security ARR and RPO, as well as any updates on their margins. CyberArk commentary. We need to hear more from management about their plans for CyberArk, the expected costs, synergies, and integration roadmap. So, what is my final takeaways? The recent sell-off of Palo Alto Networks stock appears to be an overreaction to short-term fears and the typical growing pains of a large strategic acquisition. The company's fundamentals are robust, and its long-term strategy to expand its platform into new, high-demand areas like identity security is sound. However, the risks are real and shouldn't be ignored. The high valuation and complexity of integrating CyberArk mean that this stock is best suited for long-term investors who understand the risks and are willing to be patient. The upcoming earnings report will be a key moment for clarity and could either confirm investor fears or reassure them about the company's path forward. What do you think about Palo Alto Networks? Let me know in the comments below. And don't forget to like and subscribe for more deep dives like this.